US-Iran war, the $5 trillion shockwave about to hit your wallet. Imagine this. You roll over in bed, grab your phone, open your investing app, and your portfolio is bleeding red. Your favorite stock is down 12%. Gas jumped overnight. Your grocery bill somehow got even uglier. And the trigger wasn't a bad earnings report or a recession headline. It was a war thousands of miles away between the US and Iran. That sounds dramatic, but this is exactly the kind of domino effect major investors are already running simulations on. So in this video, I want to walk you through what a US-Iran war could realistically do to markets, to the global economy, and specifically to your money. If you care about protecting your savings and turning chaos into opportunity instead of panic, hit subscribe now so you don't miss these breakdowns. I'm here to make all this complicated stuff feel like a calm chat about your future, not a panic attack. Alright, let's break this down together, step by step. Picture this possible timeline. It is late February 2026. The US and Israel launch limited airstrikes on key Iranian military sites. Within hours, Iran fires back with missiles at US bases and regional allies. Social media explodes. News channels go full red alert. And global markets, which absolutely hate uncertainty, start freaking out almost instantly. Traders slam the sell button. Algorithms start dumping risk assets. Selling triggers more selling, and in just a few days, global markets are suddenly down trillions of dollars. To give that number some weight, world stock markets together are worth tens of trillions of dollars. In a sharp shock like this, we are talking about potentially $5 trillion in value erased in the first phase alone. And the really scary part is that this kind of move can happen before most everyday investors even realize how serious things are. So why does this particular conflict scare markets so much more than the usual geopolitical noise? It comes down to one tiny but insanely important spot on the map: the Strait of Hormuz. This narrow stretch of water between Oman and Iran is basically the throat of the global oil system. Roughly 20% of all the oil used in the world every single day has to squeeze through this choke point. Now, Iran sits right next to it. And for years, they have openly prepared for the idea of threatening or disrupting that shipping lane if they ever needed maximum leverage. They have missiles, naval mines, submarines, and fast attack boats, all designed to make life extremely dangerous for oil tankers and naval ships in that region. In a war scenario, that threat would not be theoretical anymore. It would be a primary weapon. So let's link that to your daily life in plain English. If the traffic of tankers through the Strait of Hormuz slows dramatically, or even stops for a period of time, the world suddenly loses a huge slice of its oil supply. This is not like a local refinery fire. This is a global supply shock. Oil prices don't politely rise, they rocket. You could see a path where oil jumps from around $80 a barrel to over $100, then $140. And in a worst full-blown crisis scenario, a spike toward $200 is not off the table. You first feel that at the gas station, sure, but it does not stop there at all. Oil is baked into almost everything. Trucks that move your food need fuel. Ships that bring goods across oceans need fuel. Planes that fly you and your packages need fuel. Factories that make products are tied to energy costs. When oil explodes higher, shipping costs go up, production costs go up, and that pressure shows up right where you already hate it: your grocery bill, your utility bill, and the price of almost everything at the store. Now here is the twist. We are not starting this story from a calm, low-inflation world. We are starting from a world that just went through a nasty inflation spike, with central banks already nervous and debt levels already high. So if a war-driven oil shock hits, central banks get stuck in a brutal dilemma. If they raise interest rates aggressively to fight this new inflation wave, they risk forcing the economy into a hard recession. Companies cut jobs, growth slows, and markets fall further. If they keep rates low to support growth, they risk letting inflation stay high or even accelerate again. That ugly mix of weak growth and high inflation has a name: stagflation. It is one of the hardest environments for both policymakers and investors. Now people often say, we have had wars before and the world did not end, so why is this different? It is true that in 1991 during the Gulf War, and again in 2003 with the Iraq invasion, markets were volatile but did not completely melt down. There was fear, but the damage in hindsight was contained. Three big differences make a US-Iran war a much bigger deal. First, the potential objective would not just be limited strikes but possibly regime change in Iran. That is not a quick mission. That is a long, messy, and unpredictable conflict. Second, Iran today has far more advanced military capabilities than Iraq did during those earlier wars. Missiles, drones, cyber units, and naval assets designed to disrupt shipping all massively increase the risk and the potential duration of any conflict. Third, the global economy is already fragile. Debt is higher. Asset prices in many areas are stretched. Central banks have less room to cut rates without reigniting inflation. So when you stack all of that, this is not just another Middle East flare-up. It is a genuine systemic risk event. To make this less abstract, let's think in terms of three rough scenarios. Scenario 1 is a limited conflict. The war lasts a few weeks or a couple of months. The Strait of Hormuz is threatened but never fully closed. Oil spikes sharply but then settles lower as tensions cool off. In that case, global markets could lose on the order of $5 to $10 trillion, then start a slow recovery over the next year or so. Painful, but survivable. Scenario 2 is a prolonged conflict. Here, fighting drags on for a year or more. There are repeated attacks on ships. Insurance costs for tankers skyrocket. Some companies avoid the region entirely. Oil stays high for a long period. Inflation remains sticky. Central banks stay stuck. Economic growth slows, maybe tipping several major economies into recession. In that world, stock markets globally could see $15 to $25 trillion of value erased over time. That is not a flash crash. It is a grinding bear market that wears people down and pushes many investors to give up at the worst possible time. Scenario 3 is the catastrophe version. The Strait of Hormuz is effectively shut for an extended period. Major oil and gas infrastructure in the Gulf is badly damaged. Cyber attacks hit financial systems. Regional players get pulled into the fight more deeply. Now oil does not just spike, it stays at crisis levels. Supply chains are severely disrupted. Recession is global and deep, while inflation and unemployment rise together. In that extreme case, you could see $30 to $35 trillion or more wiped from global markets. Retirement timelines are delayed. Government budgets are shattered. Political and social unrest rise in multiple countries. Again, is this guaranteed? No. Is this impossible? Also no. And that is why big investors model it. So what can you, as a regular investor, watch for without living glued to a trading terminal? 1. Watch oil prices. If you see oil racing into triple digits and staying there, that is a flashing sign that supply fears are becoming very real. 2. Pay attention to tanker traffic and shipping news around the Strait of Hormuz. If tankers are being rerouted, held up, or attacked, that will show up quickly in both oil prices and market sentiment. 3. Look at volatility indexes like the VIX. When that spikes, it means markets are bracing for heavy turbulence. 4. Watch classic safe haven assets. If gold is jumping, US Treasury yields are falling, and the US dollar is strengthening all at once, that is usually a sign that big money is sprinting towards safety. The key thing to remember is that markets move before the average person fully realizes what is going on. By the time your local news starts talking nonstop about historic crashes, a lot of the big repositioning has already happened. So simply being aware and having even a basic plan puts you ahead of the majority who only react in panic mode. I am not telling you to sell everything or try to perfectly time the bottom. Hardly anyone pulls that off consistently. What you can do is think through your exposure. How concentrated are you in companies that get crushed by high energy prices? Do you have any assets that benefit from volatility or inflation? How would your job, your business, or your income hold up in a shock? Just asking those questions calmly before a crisis hits already moves you from helpless to prepared. If you are still here, you are clearly serious about understanding how global events hit your wallet, so thank you for hanging out with me and thinking this through. If you want more clear, no-drama breakdowns like this, hit that subscribe button so you do not miss the next deep dive. It really supports the channel and tells me to keep making videos like this for you. And if you want tools, books, or resources to help you navigate chaotic markets and build financial resilience, check the description below for some product links and recommendations you can explore. Stay informed, stay calm, and I will see you in the next one.